Hi, everyone. So, welcome to the live stream today. Very much excited for having you on our final session in interpretation of financial statements as we look at the final things we need to look at. In case you missed the part one, part two, and this is the part three, in case you missed the one and two, you can check the description to this video or of this video on YouTube, and you'll be able to get access to watch the part one and the part two, so you can follow in that regard. So we want to continue and go in straight into our discussion. And I see some of you joining. You are welcome to the stream. This is the final session on ratios. Like I mentioned in the introduction, this is a done deal area waiting for us in the exam hall. Definitely the examiner is going to be bringing a question on this if you're doing corporate reporting or financial reporting. So it is very important for you to understand how to do the treatment, how to do the various interpretation as we get into it in that case. So let me bring this up and then let's go in there. So we've discussed the profitability ratios. We've spoken about the liquidity ratios, and we've seen how to interpret these ratios. What we want to spend our time on in the final session is to look at the issue in relation to the working capital ratios. Then we'll share some thought on the gearing ratios and how these ratios are ultimately interpreted. So let's move on straight into the working capital ratios. Working capital ratios. Like I mentioned, the liquidity ratios tells us about the ability of the entity to pay its short-term debt as and when they fall due. And the liquidity ratios also informs us on how the entity is able to manage its working capital. But in order for us to understand well the working capital of the company, in a nutshell, we say that the net working capital of the company is the current assets minus the current liabilities. So current assets minus the current liabilities. That is going to be the net working capital in that case. So when it comes to the working capital management of the organization, the current assets are made up of a number of components. We have the inventory there. Then we have the trade receivables coming in there. There is cash there, but we are going to focus on these two. Then under the trade payable, under the current liabilities, we will look at what? Trade payables. In that case. So these are the three broad things that we're going to be looking out for and how they affect an organization's working capital management in that case. So let's look at the first one, the inventory days. The inventory days. Inventory days. Now, note that the inventory days simply measures how long a business is holding its inventory. Okay? How long a business is holding its inventory. Now, you got to be careful about this. Ideally, the shorter the period, the better it is for the company. However, it depends on the industry that a company is in. Okay? Industry or the sector that the company is in, and also seasonal variability in that particular industry that a company is in. So ideally, like I mentioned, when it comes to the inventory holding days or the inventory days, it has to do with how long an entity is holding to its inventory. The rule is that the shorter the period, the better it is for the entity. The shorter the period, the better it is for the entity. Now, an inventory holding days that is long shows that the entity is holding out into a lot of capital at the end of the day, meaning that the entity is investing a lot of capital. So when this is long, there could be lockup capital. Money that could have been used for something else will be invested in the inventories. Number two, this could result into probably obsoletances. So there could be obsolete inventories at the end of the day. If you are not careful, it could lead into maybe thefts of inventory, a lot of theft of inventory in stock, because you have a lot of inventories, you don't even know it very well. In that case, when the inventory holding days is high like that, it is an indication that the entity may not be managing its inventory levels well. So inefficient management of inventory levels. Inefficient management of inventory levels. So when the thing is high, the consequences of that is that there will be lock-up capital. Money that could be used for something else will be locked up in the investment. Now, when the inventory holding days is high like that, it means that it could result into obsolete inventories, expiration of inventories. It could result into theft as well. It could result into inefficient, or it could also indicate inefficient management of inventories. And most importantly, there may be increase in storage cost at the end of the day. There may be increase in storage cost at the end of the day. So these are a number of things which, when the inventory holding days is high, tells us that that is not good in that case. You have to also understand that the fact that the inventory holding days is high does not mean it is worse in that case, because remember what I said here. I spoke about the seasonal variability of the industry or the sector or the nature of operations of the business. Sometimes, because of discount purposes, or because of the demand that the entity expects, or because of the rise in future prices of the inventory, an entity may decide to keep a lot of inventories than it is required to keep. So these are also some things that we need to put into consideration in that case, that sometimes an entity may have high levels of inventories, but it is because the entity wants to enjoy quantity discounts. It is because the entity is buying in advance so that it will prevent possible future increase in prices, or it is because the entity expects to sell or expects more demands in the future, and hence buys more to store them for that future demand in that case. So it is not all worse when the inventory holding days is high and you begin to scream and say, hey, that is not good for the company. It depends on the company that is in the question that we are actually talking about. But the question we ask ourselves is, how do we calculate the inventory holding days? How do we calculate the inventory holding days? So we go. So inventory holding days, or inventory days, is simply going to be equal to inventories, or inventory divided by cost of sales times 365 days. In other words, our answer will be expressed in days at the end of the day. Like I said, the shorter the period, the better it is for the entity, but we have to take into consideration the industry that is in. For instance, if you are dealing with manufacturing organization, to some extent, we expect them to have a little bit high inventory days, especially because of the raw materials they must keep, work in progress they must keep, finished goods that they must keep in that case. Then also, if you are dealing with retail firms, on the average, every retail firm that knows how to manage inventories properly may not be expected to have a lot of inventories. If you are dealing with a real estate company, the real estate company may have a high inventory level, because sometimes properties could be listed on the market and it could take like maybe a year or 2 years, sometimes 5 years before those properties will be sold, possibly because of the nature of the properties involved, or the amount of the or the pricing of the property that is involved. So that is the idea about the inventory holding days, the inventory holding days. But there is another way we can measure the inventory holding of the organization, and that is to talk about the inventory turnover. Inventory turnover. Now, these are used interchangeably to mean the same thing at the end of the day. The inventory holding days tells us how long an entity is holding on to its inventories. The shorter the period, the better it is for the company, or the shorter the days, the better it is for the company. But then the inventory turnover simply indicates, the rate at which a company sells and replaces its stocks or its inventories. So inventory turnover is looking at the rate at which we sell and replace those inventories at the end of the day. And that one, the formula is going to be cost of sales divided by the average inventory. Cost of sales divided by average inventory. The issue here is that the answer will be expressed in times. The answer will be expressed in times. Now, with this one, the higher the inventory turnover, the better it is for the company, which means that the entity buys and sells fast. The entity buys and sells fast. And the lower the inventory turnover, the worse it is for the company. So you must understand which one you are dealing with at the end of the day. There is the inventory turnover on one side, then there is the inventory days on the other side. When we talk about the values you get at the end of the day, when it is high at the inventory turnover, we say that it is good for the company. It indicates a favorable movement of inventories. But if the inventory holding days is high, that means that that is not good for the company, and so that is worse for the company. But then if it is low, if you are dealing with inventory turnover, that is unfavorable for the company, meaning they are not managing their inventories well. They are not selling inventories as quickly as they are supposed to sell. But if the inventory holding days is low, that is good for the company in that organization. So you must understand which of the ratios the examiner is asking you and how you use your results to actually interpret what is happening. One is in days and the other is in times at the end of the day. That is what you need to understand when we talk about the inventory turnover. Then we go to the next one, and that is going to be the trade receivables days. Like the name suggests, the trade receivable days measures how long an entity takes to collect cash from credit customers. How long an entity takes to collect cash from credit customers. Now remember, the shorter the inventory holding days, the better it is for the company. The shorter the inventory holding days, the better it is for the company. Now, if the inventory holding days is long, it may affect the following, or it may affect the company in various ways. If the inventory trade receivable days is long, which means it takes a long time before the entity can collect money from the customers, what it then means is that the entity is at the end of the day have to borrow. So there'll be increase in current liabilities. Now, in terms of bank overdraft, because the entity would have to take bank overdraft to finance the operations of the organization. If the trade receivable days is high, it could also mean that there will be a lot of interest expenses that the entity must pay at the end of the day. If the trade receivable days is high, it is possible that the entity will incur a lot of what? Bad debt. So there may be increase in bad debt at the end of the day that a company is likely to have, and ultimately there will be a reduction in the profit of the company. So you don't want to have too high trade receivables, and you don't also want to have too low trade receivables. The deal here is that, like I told you under the asset turnover, the more credits you sell, if you sell on credit, it increases your sales at the end of the day. So the issue here is how the entity wants to manage its credit policy. Are you getting it? So if the entity sells on credits to customers with better credit ratings, or customers who are going to be paying for their debts on time, then sales will go up. But if we don't sell on credit, and we are selling solely with cash, that could indicate that we may not be able to sell more as an organization. But again, it depends on the nature of the organization we are dealing with. So the lower the trade receivable days, the higher it is for the company. But when the trade receivable days goes up, these are the consequences. There will be increase in current liability in terms of bank overdrafts. There will be increase in interest expenses. There will be increase in bad debts. And for these reasons, there will be reduction in the profits of the organization. And ultimately, that will affect the gearing of the company at the end of the day. If this thing is not controlled well, that ultimately it's going to be affecting the gearing of the company, the gearing ratio of the company. So that is the idea about the trade receivables days. Mathematically, that is going to be your trade receivables over sales times 365 days. 365 days, and we're going to be expressing our answers in X days. We're going to be expressing our answers in X days. We're going to be expressing our answers in X days. So that is the issue about that you need to understand in that case. So when that is trade receivables days, trade receivable days. So the way you interpret this, like I've said, is using these things that I've mentioned. When it is going up, these are the consequences of it, and that is what you're going to be putting into it when you are doing your interpretation. Then the last one on the working capital situation is the trade payable days. Trade payable days. Now, the trade payable days measures how long an entity also take to pay for credit suppliers at the end of the day. Now, remember that one of the short-term finance to organizations is the trade payable or credit purchases. So one of the short-term finance to entities or to an entity is credit purchases at the end of the day. It's one of the ways we can run companies at the end of the day. But then, if this is low, it could be good, which means that you are in good time with your suppliers, But then if it is high, there may be consequences of that. Okay? Because if your trade payable days are high, remember, it could result into loss of early settlement discounts. Because sometimes suppliers could give you discounts when you pay early. So if you don't pay it early, that means you lose that early settlement discount. Again, if it is higher, you are likely to lose future purchases. The reason is that if you buy from me and you're supposed to pay in 2 weeks, and you pay it in 7 months, or in 3 weeks or 4 weeks, you are likely not to get from me again, because, and I'll broadcast it to everybody associated with me, that this particular customer, this particular guy, when he comes to your shop, don't sell to them. So when an entity has a higher trade payable days, which is good for the company because that will serve as a short-term funding to the organization, there is a consequences of that we are likely to lose what? Future credit purchases, which could also affect us to, so there could be loss of goodwill at the end of the day, because now the people may not be willing to even sell to us on cash, or they will not be even willing to sell to us on credit. For that reason, when customers come to us, they are not likely to get what they are supposed to get at the end of the day. So when we are interpreting the trade payable days and it is falling, it could be an indication that yes, the entity's liquidity position is reducing, which is a good thing for the company. But then if the trade payable days is rising, then quickly the entity is not managing its payables well, and there are future consequences about it that we need to pay attention to. So that is it about the working capital ratios. Any questions, please? I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join. It helps us a lot to make the video more engaging, and YouTube and Facebook will be able to push the video so we can reach as many students as possible. So give us a smash the like button, let it turn blue. Share the video also, let us reach as many students as possible watching the playback and also watching the live stream in that case. Thank you very much, Nick, Peter, Herbert Ejay, and then Kwabena Ajiman on Facebook for the thumbs up. Thank you very much. Really appreciate it. Any questions? Any questions as we get into this? Well, in that case, YouTube, I think we have some thumbs up also coming up. In that case, thank you very much for the thumbs up on YouTube. If there are any questions, put it in the chat for me, put it in the comment section for me, and I will answer all of them. Thank you guys, YouTube. I see some of you coming in with a thumbs up. It helps us a lot and helps us to reach many students just like yourself, so together we can assist a lot of people. So now that we've spoken about the trade receivables days, the next thing we want to go into is the gearing or solvency ratio. Gearing or solvency ratio. Gearing or solvency ratio. Now, whilst liquidity ratio assesses the entity's ability to pay short-term debt as and when they fall due, the gearing ratios assesses the long-term solvency of the entity. In other words, the ability of the entity to pay its long-term debts as and when they fall due. Now, I see a comment coming in. Let's see if I can take that real quick as we continue with the discussion. From Lamini said, please help. How high trade receivable days affect gearing if they are not controlled? How high trade receivable days affect gearing if they are not controlled? It will affect, we wouldn't have any benchmark to say if it is 40 days, if it is 50 days, if it is this. But one thing is that if continuously for a long period of time, the entity is unable to control its trade receivable days, then it will borrow, buy on credit, borrow, buy on credit. You will end up funding working capital with long-term debts or even debt finances that will put the company in a position that is not good. So immediately we see that a year, in the second year, and we realize that no, trade receivable days is not being managed well, then we need to quickly ask ourselves, how does the business run its operations? And if the business is running its operations from debt, then quickly we would have to revise that. So the how high, we cannot really put a number on it, because like I said, it depends on the industry the company is in. It depends on the seasonal variations of factors available. But then if we observe it for a year, 2 years continuously, and it keeps getting worse, then quickly there has to be a signal that, hey, we have to do something about the trade receivables days. Let me know if that makes sense for you. Then Raymond Adonko said, you are always doing good. God bless you. God bless you too, Raymond, and thanks for joining us. Abdul Hakim Yakubu, thank you very much. Also with a thumbs up on Facebook. And for those of you who are giving us a thumbs up on YouTube, see some of you guys also coming up. Thank you very much. Put in the comment section any questions you have in the chat, any questions you have, and I'll be answering all your questions for you. So let's go back into our slide, gearing. So like I said, this measures the long-term solvency of the entity. In other words, it measures the ability of the entity to pay its long-term debt as and when they fall due in that particular case. Now, when it comes to the gearing ratio, we can calculate that to be the net debt over equity, the net debt over equity times 100, where our answer will be in X%. Or better still, gearing can be calculated by using the long-term debt divided by capital employed, also times 100. Now, any of the formulas can be used depending on what we have in the question. Please note that one thing the Jerry ratio tells us also is the nature of the capital structure of the entity. Okay, the nature of the capital structure of the entity. That is one thing that the Jerry ratio tells us all the time, the nature of the capital structure of the entity. Now, so it tells us how much of the capital is financed with debt, how much of the capital is financed with what? Equity or shareholders' money at the end of the day. Now, preferably, the Jerry ratio should be as low as possible. However, a high Jerry ratio does not indicate that the company is in trouble. Because according to Modigliani and Miller, the entity can even be geared about 99.9% and still the company will be profitable. So as far as the entity is profitable, the gearing should not be an issue. So in order for us to determine whether the Jerry ratio is increasing and that is a worse thing for the company, or it is increasing and there is no big deal, there is another complementary ratio that we calculate, and that is the interest cover ratio. In other words, the interest cover ratio helps us to reach a reasonable conclusion on whether the gearing position of the company is worse or the gearing position of the company is favorable, whether it is worse or favorable. Now, the interest cover, like the name suggests, measures the number of times profit exceeds interest expenses. Okay? It measures the number of times profit exceeds interest expenses. Exceeds interest expenses. Now, what does that mean? The higher the interest cover, the better it is for the company. In other words, when the interest cover rate is high, it tells us that, hey, the company is making a lot of profit to pay for its debt. And the formula for the interest cover is going to be equal to profit before interest and tax divided by interest expenses or interest payable. And our answer will be expressed in X times. Our answer will be expressed in X times. Our answer will be expressed in X times. So the higher the interest cover, the better it is for the company. It tells us that, oh, even though the gearing may be rising, the interest cover is rising, which means the entity is making more profit to cover for interest expenses. So there may not be any gearing problem that we have to look out for. So like I said, the interest cover ratio helps us to reach a conclusion on whether the gearing position of the company is worse or it is favorable. But if the gearing ratio is going up and the interest cover ratio is coming down, then it tells you that no, probably the company is borrowing the money and is using it to deal with recurrent expenditures, like we see in this country like Ghana, in that case, where we borrow a lot, but they are used to pay wages and salary and increasing the salaries of some people at the expense of others, and we borrow money to finance some of these expenses. So if the same thing happens to an entity, a company, where the company is borrowing the money, but the company is using the money to pay for, say, dividends, the company is using the money to pay for other recurrent expenditures and not using the money for revenue generating investment, then what is going to be happening is that the gearing ratio will go up and then the interest cover will be coming down. That tells you that in the future, the entity is not earning even enough profit to be able to pay for interest expenses, not to talk about the retainment of profit to repay the loan when the time is due for repayment. That is the idea about the interest cover ratio. And that is what you must understand about the gearing ratios. Any questions, please? Any questions, please? Any questions? So that is it also about the gearing. That's it also about the gearing. So when it is high, you don't just say, oh, the company must manage its gearing ratio very well. Oh, whatever. No, you have to ask yourself, what is the interest cover? Now, in situations where you cannot calculate the interest cover or it is not given in the question, it will be excellent for you to state in your interpretation that this will be well understood, assuming we had the interest cover. So if you state that in your question like that, it informs the examiner about your understanding of exactly what you're doing and your ability to be able to really use what you are learning well in practice. And that is the thing you need to understand when we talk about the gearing ratios. So we've looked at the profitability ratios. We've discussed the liquidity ratios. We've looked at the working capital ratios. We've looked at the gearing ratios. All these relates to the company. But the final question we ask ourselves is, okay, how about our shareholders? How about our shareholders? What do they stand to gain at the end of the day? So let's get into the shareholders. To look at the position of the shareholders, we're going to be looking at the investors ratio. The investors ratios. The investors ratios. Now, when it comes to assessing the investors ratios, there are a number of indicators that we're going to be using. The first one is called the price earnings ratio. The price earnings ratio. Now, the price earnings ratio simply has to do with the comparison, the measure of how much the entity is making as a percentage of the price of the shares of the company. So the formula that is going to be coming here is that it is a share value or the price per share. Share value or the price per share divided by the earnings per share, EPS, divided by the earnings per share. So if you look at the price of the share, so for instance, if you look at MTN share price, whatever, maybe it is 0.78 per share. Then if you look at the dividend they are paying, whatever, let's say 0.25 per share, the comparison of those two figures gives us the price earnings ratio at the end of the day. Ideally, a higher price earnings ratio indicates that the entity is making a lot of earnings on the value of the shares of the company, and the investors are making a lot at the end of the day. The price earnings ratio also helps the shareholders to understand that, okay, it means that there is likely to be better earnings going into the future at the end of the day. But the fact that the entity is looking at the price earnings, you know that the earnings per share can be calculated as the profit for the year or profit after tax divided by the number of shares. So that gives us the earnings per share if you want to calculate it at the end of the day. The earnings per share simply means if the profits for the year is shared among the shareholders, the current shareholders, how much will each one get? Now, earnings per share will be spoken about much later on when we are discussing IAS 33 earnings per share, because it's a topic on its own and we will talk about it later on. 2 is to look at the dividend cover. Now, the dividend cover is like the interest cover. Okay, the dividend cover is like the interest cover. In other words, this measures how many times an entity's profit covers or pays for the dividend. So for instance, so the formula is going to be the profit after tax or profit for the year divided by the dividend per share. So for instance, if a company makes a profit of say $20 million, okay, and they paid a dividend out of say $50 million, it tells you that the dividend cover is somewhere around maybe 3, 4, 1.5 times, I guess. Let's see if I can bring that up. 20 divided by 15, 1.3 times, I guess. So it means that the profit the entity makes as compared to the dividend is 1.3 times. The higher this ratio, the better it is from the perspective of the shareholders at the end of the day. But you got to be careful, because if companies are paying dividend a lot now, then they are likely not to make a lot of investment into the future, which may affect the future profitability of the company. So in as much as we want the dividend cover to be high here, there is a future consequences of it. Because if an entity makes a profit of, say, 20 million, and they pay 50 million of that out as dividend, which one will they use to run the business continuously? So sometimes the dividend cover ratio could be low. However, that tells us that the entity has retained a lot of money or a lot of the profit, and they will reinvest that, and the share value of the company will go up. And when the share value of the company goes up, what happens is that the price earnings ratio is going to go up in the future, which tells us that we're going to be making a lot as shareholders in that case. Which tells us that we're going to be making a lot as shareholders in that case. Now, if you want dividend per share, as you can see here, it is simply going to be the dividend payable divided by the number of shares. The dividend payable divided by the number of shares in that case. Then the last thing is the dividend yield. Like the name suggests, when you hear the word yield, what comes to your mind? Returns. Okay, so dividend yield simply measures the returns that shareholders are making on the shares at the end of the day. So that is going to be your dividend per share divided by the share price times 100. Times 100. Again, the higher the yield returns, the better it is for the company. Okay, the higher the rate, the returns, the better it is for the company. So let's say that, for instance, you buy shares in MTN, and the MTN pays dividend of whatever, let's say 0.25 Ghana cedis, and then the share price is whatever, let's say 0.85 Ghana cedis times 100. What do you get as your returns? Let's punch it up. Now, this may not be the current information running, okay? So this is just for illustrative purposes, so that somebody doesn't say that this is not what MTN is paying. We're just using it for illustration. Times 100. Now, that is about 29.4%. 29.4%. Is that good? Yeah, probably it could be good. 29.4% returns every year. That's not bad. That is the idea about what? The dividend yield. So when it comes to the dividend yield also, the higher, the better it is for the entities at the end of the day. Now, this ratio could be low if an entity decides to retain a lot of the profits to reinvest. Because what happens is that if the share price goes up at the end of the day, and the entity doesn't pay a lot of dividends out at the end of the day, then the entity is going to be reinvesting the money so that they can put in there. So sometimes a lower dividend yield may not indicate that shareholders are losing money. A lower dividend yield could indicate that the entity is not paying a lot of dividends out now, but they are reinvesting the money, in which case the share price of the company is going up. And like I say all the time, no company on the planet is under obligation to pay any shareholder dividends. If you want dividend, you can sell your shares and you get some dividends at the end of the day. So not all companies actually pay dividend. There are certain companies they pay every year. Some companies they even pay quarterly at the end of the day. Other companies they don't even pay any dividend at all. It's a zero dividend policy. Or other companies they wait for a long time before they declare dividend. The idea is that the dividend yield could be low. However, that may not indicate that the entity is not doing well or shareholders are losing money at the end of the day. These are the things you have to understand when we talk about investors' ratios. Any questions for me real quick? Any questions? Any questions for me real quick? Any questions? Let me know. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join, and also share the video. Let us reach as many students as possible. Most importantly, comment in the comment section any questions you have for me, any clarification that you want, and let's see what we can do in that case. Lamini said, perfect, said, okay. So I think to your explanation that I gave you, Francis Jerry, Amrago said, great job. Thank you, Francis. Abdul Hafiz Isa said, great. Thanks for the clear explanation. All right. Then we have Benjamin said, good job. Thank you, Benjamin. On Facebook, Ajay Marfo, and then Francis Jerry, Amrago, Emmanuel Jabin. Thank you very much, you guys, for the thumbs up on Facebook. We really appreciate it because that helps us a lot to reach a lot of students across the continent and across the globe in that case. Now, remember, in case you missed the part 1, the part 2, this is part 3, the final session. In case you missed the part 1 and 2, you can go to YouTube, and under this video on YouTube, you will look at it, you will see the part 1, the part 2, and the part 3 in that particular case, so that you can watch them and look at ratios. Like I said, this is a done deal area in corporate reporting. It's a done deal area in financial reporting, partly done deal in man accounting, partly done deal in strategic case study. So it's very important for you to understand how these things are interpreted, most importantly, so that you can score a higher mark at the end of the day. Vida Derry said, please, can you explain the interest cover? We said that the interest cover is measuring, let's make that a little bit large. The interest cover is measuring the number of times profits exceeds interest expenses. What does that mean? It means that if we compare the profits we are making as an organization before interest and tax to the interest expenses that is due to be paid, how better are we? The more the interest cover, or the higher the interest cover, the better it is for the company. What does that mean? It means that even though gearing ratio may be increasing, the entity is using the money and investing the money into revenue or profit generating assets. For that reason, they are generating a lot of profit from those borrowed funds, hence the interest cover is high. In that case, when the interest cover is high, a rise in the gearing may not indicate future gearing problems for the organization at the end of the day. But like I said, if gearing ratio is going up and the interest cover is coming down, it could indicate that either the entity is borrowing money to repay recurrent expenditure or non-revenue or non-asset producing investment, or using it to pay wages and salaries or dividends. For that reason, the interest cover being low at the end of the day. And then I illustrated that with what we do here in this country. We borrow a lot, especially this administration. We borrow a lot, but most of the borrowing go into recurrent expenditures. Hence, it affects the bottom line on GDP to the debt ratio of the country, keeps rising at the end of the day. And public sector students, you will look at that later on when we looking at the ratios in that case. So that is the idea about the interest cover. Higher interest cover means good. We are making a lot of profit to cover for interest payable. Does it make sense? Vida Dairy, let me know if it does. Then what? Are there any limitations of using EPS as a performance measure? Yes, there are a lot of limitations using earnings per share as a performance measure. One of those limitations is because of the dilution in the earnings per share, the dilution in the shares of the company. Because if a company issues a share option, or a company issues convertible loan notes, what happens is that those things will result into dilution in the earnings per share. So that may not give us, but even though those things haven't happened yet, we will take them into consideration, or we may take them into consideration when calculating the earnings per share. So that gives us a bit vague picture about really the earnings per share of the company. The second thing is that the profit for the year is subject to a lot of accounting manipulation. The entity may decide to overstate certain things, not depreciate asset properly, or not classify expenses properly. Instead of writing off certain expenses, the entity may capitalize it, in which case the profit will go up so that the earnings per share will also go up. So these are some limitations we can mention about earnings per share being used as a performance measure in that case. Vida Derry said, thank you. You are welcome. So, Lamini, let me know if that makes sense for you on the question that you asked about earnings per share. Any other questions for me? Any other questions for me? Let's see. Okay. So, Lamini says, let's see. Okay, I thought, oh, that is right. Lamini says, thank you, sir. Okay, you are welcome. So that is basically what you need to understand when we talk about the ratios. Like I said, in case you missed the part 1, the part 2, this is part 3, the final session. Please watch all of them and make sure you understand how the interpretation is done. Then practice a lot of questions, okay? Don't just pick a ratio question, look at the solution and read the solution and think you know what it does. No, the explanations we've had throughout these 3 sessions on ratios, use those explanations to write your own interpretation. And if you are attending lectures somewhere, you should be able to have access to your lecturers where they can assist you in some of these things. In that case, for here, my students, that is what we do for our student, definitely, because when I teach ratios, after teaching like this, I give questions. You're going to write your own English based on your own understanding. Then you will be monitored. Okay, this statement you made here, this is not how it's supposed to be made. This statement you made here, this is not how it's supposed to be made. You should have said it this way. Then we fine tune it in your own words over a period of time. And I hope that wherever you'll be attending lectures or you're attending lectures, you will be able to get something like that, because this is a done deal area, requires practice and continuous guideline to be able to achieve the ultimate goal in that case. So that is what you need to understand about ratios, interpretation of financial statements, and how we do this in the exam. So done deal, corporate reporting, done deal, financial reporting, and I wish you all the best as you look well to this particular topic and prepare yourself for the exams in that case. So I'm going to conclude around here today if there are no other questions for me. And God willing, on Monday, we will continue again with another topic. In that case, we had a number of topics coming in the course of the week: limiting factor analysis, transfer pricing, cash flow statements, some accounting standards also coming in with the requests from you guys. So we're going to see some of these topics will be picked up from next week and discussed in that case. Remember to follow me on Instagram if you're not following me on Instagram, because our meeting details will be posted there. And on Instagram too, I share other content that we don't share here, and you can get access to them as well to help you shape you into a better person, so that you can become more successful in your life endeavors. So that is it about that. Thank you very much for joining the stream throughout the week. And I saw some names, very similar name for those of you guys who joined us throughout the week. I think Raymond was here, Lamini was here throughout the week with us in that case. And then some other few people of you also were here. Thank you very much for the support and the continuous staying with us. And I'll catch you same time next week on Monday, 4:30 p.m. as we continue with our discussion. Like I say all the time, do not put the book away. We are done with 7 weeks. Okay, we are done with 7 weeks. We are left with 9 more weeks to go for the ICA November 2021 examination. And one thing you want to do is to make sure that you don't wait till the exams is near, then you start attending revision sessions, intervention classes, and all that. No, intervention classes are for the people who have been working all this while and require a little push for them to become successful. Hafiz Abdul said, please, assuming there is a discontinued operation, do you have to eliminate its transaction before calculating the ratios? Yes, you have to do it in both ways. A better analysis will be reached when you do the you calculate the whatever ratio that has to be calculated, including the discontinued operation. Then you calculate the ratios excluding the discontinued operation. Usually that will come in if you are dealing with ROSI, you are dealing with assets turnover. These two, especially when there is discontinued operation. So it could be included when calculating the ratios one-sided, then outside it. So in other words, you will calculate two ROSIs, two assets turnover. Then in your interpretation, you contextualize that had it not been this would have been gearing ratio, but because of the discontinued operation, this is the impact now on the ratio at the end of the day. So it will be both ways to enhance your interpretation at the end of the day. Because remember, you are comparing current year with the previous year. For that reason, in the current year, in the previous year, they may not be discontinued operation. Hence, you have to do the ratio without the discontinued and the ratio with the discontinued, so you bring a better picture in the analysis that you are doing. So Hafiz, Isa, that is what you do in that case. Let me know if that makes sense for you. Let me know if that makes sense for you. Any other questions for me real quick? Any other questions? All right. So thanks very much for joining us, and I'll catch you same time next week. Remember to follow me on Instagram. Subscribe to the channel in case you've not subscribed to the channel, and stay connected. Subscribe to the channel. Click on the bell notification icon. That way, when I go live, or you didn't even get a notice on online. When I go live, YouTube will send you the notification so you can join the live stream in that case. Okay, so Havi said, thanks very much. Well, very well understood. Okay, that is awesome. So that is it. Have a blissful weekend, and I'll catch you next week as we continue with our discussion. Remember, continue to study, continue to work hard, and stay blessed. Bye-bye.